Hello traders, Corey Mitchell here with FX at the Street. Today I want to look at trading with stop loss orders and where to place them. I do trade with stop loss orders. Some traders opt not to do it. That is typically longer term traders who have bigger areas where they would have to get out of their positions. So for example, they may buy something and then they're not planning to get out unless it makes a really drastic move against them. In that case, they don't need to place a stop loss right away. But then if it's far away anyway, why not place it? Just in case you're not watching when that price is hit. The other types of traders that may not use a stop loss are day traders, and that's because they're sitting there watching the price action. So if the price moves to that area, they can just click out, and maybe they want a bit of discretion to be able to give themselves a tiny bit of extra room just in case they think it's a bit of a fake out or something like that. But overall, I think it's very good to trade with a stop loss, even if you're a longer term trader or a day trader. So today we're going to look at how you can place, where you place stop loss orders, and at least a couple ideas on it. There's many ways that you could place a stop loss order, and where to place it, and then we'll just look at a couple variations of how you can determine that. So anyone who's followed me for a little while knows I like to trade off technicals and support and resistance areas. So anytime we see something like this, where we've had a pullback, we're near maybe the top of a short-term range or something, that appeals to me. Overall downtrend, top of the range, and then we get one of these, a nice consolidation. So this is what I like to trade quite often. And then I wait for the breakout at the bottom. So I'm waiting for at least 3, often 4 price bars, and then the breakout. This signals my entry to get in once it breaks below the consolidation. And then a stop loss goes right above the prior high, in this case, since we're going short. So this red line marks your stop loss. And how many pips you want to give it, it's up to you. I usually only give it a couple, plus the spread. The spread is quite large in some pairs compared to others. So you want to, when you're going short, you want to add a few pips plus the spread. Or basically whatever the spread is, multiply it by a couple, then add the spread back on, so that you're giving yourself a tiny bit of room above that spread, above that high. But really, if it gets back up here, you're likely in trouble anyway after it's broken down. If it breaks down and then goes right back up, that stop loss is probably going to get taken out, and that does happen. The tendency is for people to think, well, give it much more room, put your stop loss up here. And that is a valid argument, because yes, you're less likely to get stopped out if this pops back up. Maybe it does a few oscillations and then heads back. We had a circumstance like that fairly recently here, where maybe you took one of these short and then the price drops, but then it comes right back up and just moves a tiny bit above. Then it drops and moves a tiny bit above. Then it drops and then moves a tiny bit above. That's a very frustrating situation. If you had just given that first trade more room, then you wouldn't have got potentially stopped out on any of these trades. But at the same time, what's happening is that you're reducing your reward to risk. So anytime you use a bigger stop loss, if you're entering short here and placing a stop loss, let's say way up here, your risk is now much bigger. That means your position size has to decrease, or it should. If you're not decreasing your position size for increased risk, something's wrong. The more you risk, the smaller your position size should be. So on this little move here, we're risking about 34 pips. That's the last number to the right on that little box that's showing up. If we put it up here, we're risking 95 pips. If we put it somewhere in the middle, of course, we're risking a little less, maybe 60 pips if we put it here. So that would reduce our position size compared to putting it here. Then maybe we're just expecting to get out at the bottom of the channel, or maybe we're expecting it to continue. But either way, no matter what happens, the more we've risked and the more we've reduced our position size, our reward to risk has now dropped. So if you just took this tiny area, even if you got it at the bottom here, you probably would have made about 2 to 1 on your position, meaning you make twice as much as you risk. So if you got it right here, you'd have made 2 to 1. You're risking, and this can be any dollar amount you want in Forex. Just convert it. We have position sizing articles on thestreet.com. Just type thestreet.com position sizing and you'll see one of my articles pop up. And you can also find all these under trading tips. Position sizing's down near the bottom, I think. But very important article to read. And the other one you're going to want to read is on this topic right now: win rate, reward to risk, and finding the profitable balance. So the more room you give your trades, your risk goes up. Now if you go short here and you get out down here, you've risked this amount and you've actually made less than that on the trade. In order to make 2 to 1, now that price has to drop way down here to get this risk reward up to 2 to 1. So you need a much bigger move from the market in order to sort of offset your risk, so to speak. So there's a trade-off. There's with a tighter stop loss, you're going to have bigger reward to risk ratios. If you want to give trades more room, the reward to risk is going to drop off, but maybe your win rate, the other factor in this equation, could improve because you may not get stopped out as easy. So it's really a trade-off. There's no best way to do it. It's really up to you and how you trade, but that's the trade-off. I prefer to just keep it tight. And then you can always, at least if you're watching your trades, let's say it drops below here and then starts to move back up, you can just get out. That's not saying you have to do that. You can leave your stop loss and profit target where they are. A profit target is just where you want to get out with a profitable exit. But you can always drop that stop loss as the price moves. Maybe after the first pullback, you drop it down. So that is what we call a trailing stop loss. And that allows you to reduce your risk anyway. So instead of giving it so much room off the start, if you're entering in the price direction when it's moving that direction, so this was starting to drop, so I'm expecting it to continue dropping. If that, I can just follow that for a little bit and see if it continues to drop. And if it does, great. If it doesn't and starts to turn right back up, then I can consider getting out, because if it gets back up to the top here anyway, I can probably take another trade. Let's look at one that's been in an uptrend. So the British pound, US dollar. Moving in this big range, but we can see here, it's coming off the lows here, bottoms out. Actually went short here, expecting a little bit more to the downside, didn't come. And then we start to see this trend channel develop. You notice I do not care if they're intersecting exact lows. I just want to see the area where the price is bottoming. On this chart, we don't see any consolidations, but certainly if we drop down to a 15-minute or even a 30-minute, we would see lots of consolidations. So looking for those ones near the pattern, ideally when maybe we've seen a couple false breakouts, as we talked about. Those happen quite often. Here's a nice consolidation. Here's another one that might have been tempting to take. You may have got out with a small profit, but again, if it drops and then comes right back to your entry point, you can always get out and look for another entry. In this case, if you held on to it, you would have been stopped out because the stop would have been right below there. And that's okay. That's why we also want to consider this reward to risk ratio, so that when you do win on trades, even if you've been stopped out on a few, then it doesn't matter. If you lose this one, but you make on this one and you make a nice profit on this run up, this profit should more than offset the loss. And that's why we want to have a positive reward to risk ratio, where we're making more on our winners than we lose on our losers. That also means you don't have to win as many trades. If you win 50% of your trades, but you're making 2 to 1 reward to risk ratios, then you're still going to be quite profitable. Even if you're winning 40% of your trades, you're going to be quite profitable. So you can be wrong a lot with nice reward to risk ratios. That's why I prefer to use tight stop losses. But again, as with this one, you could have given it more room. Here's the danger of giving it more room, though, is the price can always run more room than you've given it. Let's say we decide to give this trade, it looks like it's starting to turn back up. Let's say we give it more room. We put our stop loss down here. You'd still get stopped out there. You'd have to give it so much room. So the price can always keep edging past a level that you think the price should stop at, and it can just keep edging past it. So giving it more and more room is a dangerous proposition, in my opinion. I'd prefer to keep it tight and just maybe monitor that position a little bit, or just not worry about getting stopped out. So by monitoring, I mean if it breaks out but then it comes right back, you can just get out and then look for another entry, like this one down here. Or if you just let it play out, then you want to be looking at your reward to risk ratio and saying, okay, if I get stopped out, that's fine. I'll get in on another one and I'll make more on that one, like we did, like this situation here. So we're still near the trend line, started going higher, stop loss right below the lows there. So this is not the only way to trade or place stop losses. Actually, before I go on to another method, let's look at, even if you're day trading, the same sort of concepts apply, where typically I'm just looking for those areas of interest. We have a resistance area developing here. We popped up, tried to go higher, pulled back to support, popped back up. Here's a nice stall out of several candles, 3 I believe, and the price drops. So that'd be the situation you want to put your stop loss right above. So whether you're day trading an hourly chart, daily chart, to me it doesn't really matter. I'm always placing my stop loss just above the area where I'm getting triggered in. So not everyone trades this way, but typically you're going to place it, so even if you decided to go short down here, I think the most logical place to put the stop loss is above the recent swing high, Or if you're going long, you see these little consolidations here and go long, then you want to put that stop loss below. And a target, this is moving up, so we expect the price to reach this prior high or maybe a bit above, so targets would go in here. There's also another way you can do this, and I have this indicator down here. This is a average true range, and all this is telling us is how much the price typically moves during a price bar. So instead of just picking a random level, and it's not really random, but let's say you see this consolidation or this one and you decide to put a stop loss right below there, you're going long there, just for an example. Now to me that's a perfectly adequate stop loss. Another thing that you could do is if you're entering as the price breaks out of this 4-bar consolidation, or 3 bars in this case, breaks out, keeps running. So I'm placing my stop loss there. What you can also do is look at the average true range. So this, as I mentioned, is just telling you how much the price moves within a price bar. And a lot of traders will stick a stop loss at 1, 2, or even 3 times the average true range. So this means if you're entering at, let's just round it off, 110.15. 110.15 is the entry. So that's where we're going to buy. And when that occurs, or even just before, we can look at our average true range. What is that saying? So right now, the average true range, if you look at this number over here for whatever price bar you're on, this one here, it is, this one was our breakout bar, 15.4 pips, because it's using this same scale as this. So you have 0, 0, 0, 0, 0, 155, or 154. So 15.4 pips. So that means you could give this stop loss either a 15 pip stop loss, a 30 pip stop loss, a 45 pip stop loss. And let's just kind of look at... So this range itself is about 24 pips. So if you placed a stop loss at 2R, that would place it just a few pips below. So basically 30 pips away from your entry. Yeah, right about there. Go right there. If you wanted to give it a 3 ATR, you'd have to go 45 pips below your entry. And it would go down here in this area. Yeah, about right there, 45 pips. So that's another way you can do it. That's at least a more quantified way. If you do want to give the trade a bit more room, or even less room, let's say you see this breakout and you say, I'm going to give it 1R. The price only typically moves 15 pips in this case, an hour. So if it doesn't keep running, I'm just going to get out. So maybe you give this trade 1R, sorry, not 1R, 1 ATR. And in that case, your stop loss goes right here, about 15.4 pips below your entry point. And in that case, you would not have been stopped out. This price just kept running up. Get rid of this box just so we can see those price bars a bit better. Yeah, so if you entered right here, the price just kept running, and that 1 ATR stop loss would have worked just fine. And of course, you can use any amount that you want, 1.5 ATR, 1.6 ATR, 2 ATR. But it gives you, same with the other approach where you're placing it outside the swing low, or if you're going short above the swing high. This too is another systematic type method that you can use where at least you always know your stop loss is in the same spot. And then that way, if you're winning or losing, you at least know why it's happening. If you always are using a different stop loss, sometimes you place it in random spots. You just decide, I'm just going to give this trade a few pips. On another trade, I'm going to give lots of pips. But it's not based on anything that you can visually see or chart or something like that. Then it's kind of a random stop loss. I like these two methods because you always know you're doing it the same way. You have levels that you can place the stop loss off of, or with the ATR, you have your indicator, you know, okay, I'm giving this one 15 pips because my ATR is 15, or I'm giving it 30 because I'm going to use an 2 times ATR stop loss. And both those methods are fine. I don't recommend necessarily one over the other. It's just whichever one suits your trading method. This one suits my trading method fairly well because I'm usually getting in near swing lows or highs, but you may not be. You may... Some strategies maybe wait till momentum starts. In that case, you're maybe getting in up here, and in that case, you could place a stop loss below each candle as it moves up, or you could use the ATR approach, where as the price moves, you're just moving your stop loss 1 ATR or 2 ATR behind wherever the price is, or wherever it closes, or whatever you're going to base it on. So those are two methods that I think will really help control the risk on each trade. Risk control is so important, especially in currency trading, because we can get just some pretty chaotic movement, and you never know. Even if you think you have a trade really dialed in, it can always make one more move in the other direction before it goes. And you just want to control that risk in case that move turns into a big one against you. So I hope that helps you out. Until next time, happy trading.